Hi, John. Yeah, so Gap earnings are out, and it does look like shares are moving all over the place here. So for the quarter, Gap putting up an earnings beat of 57 cents. The street was looking for 55 cents. So that's a beat. Revenues missing slightly at $3.73 billion. The street was looking for $3.74 billion. Comparable sales, they did grow 1%. But that is about half of what the street was looking for. If you break down by brand, Banana Republic very strong, much more than expected at 4%. The street was looking for that to be flat. Athleta is down 9%. Now, it's their smallest business. And there is weaker than expected gross margin at 41.2%. The street was looking for 41.9%. Looking at the full year outlook, the company is reaffirming its full year net sales growth outlook. And then they're giving us some details about operating income and sort of the hit that tariffs will have there. And I think it's worth explaining that I spoke with CFO Katrina O'Connell, and she said that the new operating income guidance does assume a $150 million to $175 million negative tariff impact, or basically what it's not able to mitigate. That is up from May's assumption of $100 million to $150 million. And as a part of its mitigation strategy, Gap did bring in some inventory early, which she says is partly why you see that number up about 9% year over year. And I also spoke with Gap CEO Richard Dixon, who said that it is expanding its manufacturing in areas like Guatemala, Mexico, and Haiti, again, to help offset some of that tariff impact. And when it comes to pricing, Dixon said they're making targeted adjustments with pricing, as we always do, but also said that as our brands get more relevant, it is increasing our price elasticity. We're driving higher sell-throughs at full price. We do have less discounting as a result. So shares bouncing all around as we wait for more color from the call for shares of the Gap. John, back over to you.
Yeah, it looks like mostly a drop here. Court, is your interpretation thus far? Of course, we have to listen to the call and to an interview coming up on CNBC, that this reaction has to do with that tariff impact surprise, perhaps?
I think so. And look, I think we all know, that it is a fluid situation, but we also know that earlier in the year, companies were having to make some assumptions when they were going out on a limb and putting out these guidance forecasts. And while China is still holding at 30% right now, and that was what was assumed in May for many of these retailers and what they're still assuming, when it comes to the rest of the world rate, that one is what's different. For example, Victoria's Secret this morning said that one had been an assumed rate at 10%, and now it's at 20%. And I think that's also what we're looking at here for the Gap. It's sort of that outside China area that is a little bit higher than it was before. The good news, though, for Gap, like most other retailers, is a lot of it is being able to be mitigated. But of course, not all of it, which is why I think it was important to give you some of those detailed numbers from the CFO.